think it's the best tool that's available. I don't think it's a silver bullet for every single thing. So, for example, that probably mentioned with wages. If you earn X amount of dollars per year and money supply is growing at a certain rate, you may still have trouble with your employer getting the wage that you deserve to kind of keep up your share of the ledger. That's still a challenge, but at least it helps with the savings side of the problem, which is to say, if you're looking at things you could purchase, like a savings bond that's giving you interest rate below the money supply growth rate, or a savings account, or a very highly valued equity, or a very highly valued house, that's not immediately meeting your shelter needs. Bitcoin is a very powerful savings device.
In a world where saving feels futile and inflation eats away at every dollar, macro strategist Lyn Alden offers a new lens. The problem isn't just the economy, it's the money itself. We live in a system designed to devalue what we earn. But Bitcoin, she says, may be the one tool that lets people break free.
So it's hard to talk about a solution before we understand the problem. And I think that many people realize that the system is broken, but they kind of have trouble understanding why the system is broken, what's actually breaking the system. And people like you and I would say the system is broken because the money is broken. And you literally wrote the book on this, Broken Money. So we're going to talk about broken money today and how Bitcoin is basically a blueprint for individuals and families to be able to escape that broken system.
This broken system isn't just about politics or policy. It's a deep flaw rooted in technology. For Alden, the shift from physical settlement to instant digital transactions created a power imbalance. Institutions stepped in to fill the gap. And that's where the trouble began.
Here.
So I try to describe it as a technological problem first and foremost, but that doesn't necessarily require really deep technical understanding. There's just some key points. And so I kind of separate the financial history into kind of three main eras. So the first era was pre-telegraph. That's when everything was analog. And so there were monetary technologies, things like coinage, things like paper and the printing press. We don't really think of them as technologies today, but at the time they certainly were these new technologies that allowed basically forms of ownership and money to move around quicker and transactions to move around quicker.
But the real shift came when communication sped up, while money didn't.
But once they invented the telegraphs, that was the 1830s, and then by the 1860s, we had cross-Atlantic cables, cross-continental cables, and you could talk almost instantly or send low bandwidth signals almost instantly around the world. And that means you could do transactions almost instantly around the world. And the way that I describe the problem is that opened up a really big mismatch between transaction speeds, which could now just go around the speed of light almost, and settlement speeds, which at the time were still physical gold and other physical valuables.
To close that gap, centralized banks became the middlemen. And with that centralization came vulnerability, manipulation, inflation, and erosion of trust.
And the main way that they bridged that gap was to have a big centralized ledger. So either big commercial banks or in many cases a central bank that all the commercial banks build on top of. And that becomes a trusted layer that everybody has to use to bridge between settlements and transactions. And whenever there's a really big centralized honeypot, it's prone to manipulation. It's prone to people misusing it for various reasons and kind of breaking that trust.
Bitcoin, according to Alden, fixes this, not by being digital money, but by being a full-stack settlement system, one that no longer requires trust.
Bitcoin, it represents multiple things, but in this context, it represents the invention of fast settlements. So after basically a century and a half, we finally had the settlement side catch up to the transaction side.
The result is a monetary system with no centralized control, no arbitrary supply increases, no backdoor bailouts, no hidden taxes. Which brings us to inflation.
Structural inflation, the underlying cause, is growth in the money supply on a sustained basis. Now, you can have temporary causes of inflation, of price inflation, things like, for example, a war or a shortage, or other basically anything that harms productivity can make prices go up temporarily in a certain area. They will generally, if the money supply growth itself is not the issue, those prices will come down in time, and or they will lower the prices of something else that people aren't buying because they have to prioritize buying this thing that has gone up in price, if it's something core like food or shelter. Um, and but in order to get sustained, persistent price increases like we see today and for a very long time, it requires that the money supply itself is increasing. That's an axiom that's true everywhere.
This inflation hits hardest not through grocery bills, but through asset prices. Housing, education, stocks, everything climbs faster than wages. And that's no accident. The system is built to reward those with assets and cheap access to credit.
The closer you are to the source of money creation, generally the more you benefit from this perpetually expanding money supply system. And so, for example, if you're a large bank, if you're a large corporation, if you're high up in these types of entities, or otherwise, if you're wealthy and you're able to access cheap credit for very long periods of time, you're kind of perpetually, in a self-reinforcing way, advantaged from that system. You're able to basically short fiat currency. You borrow fiat currency at a lower rate of interest than its supply growth rate. So you're shorting something that's losing its value, and you can go out and buy all sorts of financial assets, buy cash flow producing businesses, buy all sorts of things. Whereas if you're generally on the lower end of the income and wealth spectrum, it's harder for you to access credit. It's very expensive when you do get credit. And then you can, ironically, like, you pay more for banking services just because you're dealing with fees and problems there.
This is the so-called Cantillon effect. Those at the top get to borrow money before inflation hits. Everyone else is left scrambling. For Alden, Bitcoin is not just a way to escape, it's a way to opt into something better.
Bitcoin protects you from that long-term monetary debasement, if you're willing and able to withstand some degree of volatility along the way, because you're also dealing with the fact that the world is gradually understanding what this asset is.
So what have we really uncovered? A financial system that doesn't just make mistakes. It operates on a design that quietly extracts value from ordinary people while rewarding those with proximity to money creation. Inflation isn't an accident or an unfortunate side effect. It's a feature baked into the structure of fiat currencies. Lyn Alden peels back the layers of this system to reveal how centralized control, unchecked expansion of the money supply, and the concentration of financial power have created a rigged economy. But she doesn't stop there. Alden points to Bitcoin as more than just a speculative asset. It's a decentralized, transparent, and disciplined monetary network. With a fixed supply and no central authority, Bitcoin offers an exit route from a system where saving has become punishment, and planning for the future feels like chasing a moving target. For those willing to understand it, Bitcoin becomes a tool not just for investment, but for personal sovereignty.
There's a lot of right answers for how much Bitcoin you should have, but I think that if anyone who looks into it generally finds that the zero is not one of the right answers. So I think get off zero. There's some research that shows basically the more someone is knowledgeable about Bitcoin, the larger share of the net worth it ends up being. So my general view is that if there's a time where it makes sense for you to increase your holdings substantially, I'm not the one that tells you that. You're the one that figures it out for yourself.
Bitcoin really the answer to our broken money system? Or is it still just a bet too far? Let us know what you think in the comments.